So hello everyone, my name is Matt Cinsrello, and I'm the owner and managing partner here at U-Nique Accounting. You can learn more about what we do by visiting us at u-niqueaccounting.com. While you're there, I recommend you check out our blog and visit our downloadable guides page where you can download some free content. Also, if you're wondering what I'm drinking today, today's beverage of choice is a blood orange seltzer water from Trader Joe's. And if you notice my cup, it is bearing the hashtag Make Today Count. This is the slogan for my Best Friends Foundation, which is a close and personal foundation that I'm a board member of. A link will be provided to a form you can fill out if you or someone you know needs help dealing with the impact of cancer in their life. So let's go ahead and jump into today's topic. Today's topic is Cash Flow Forecasting 101, what it is and why you should be doing it. So let me start off with that when done properly, and let me emphasize properly, a cash flow forecast will become one of the most important tools for running your business. If you have a growing business or are looking to grow and expand, I highly recommend that you utilize a cash flow forecast. So why did I emphasize the word properly? A cash flow forecast is never duplicated. You could have 100 people sit down, give them the same information, every forecast will be different. So it really comes down to the advisor and or CPA who's preparing it. You must trust their methods, calculations, and thoroughness, because you're going to rely on this information to make key business growth decisions. So here's an example. This goes back a while ago, but there was a tool and die manufacturing company where we got approached by their bank because they were worried about them, and their current CPA said that they should just close the doors. They couldn't make it. So we sat down, put together a forecast properly with a P&L, balance sheet, and saving the cash flows, looked at the business, looked at their debt levels, looked at the forecast, and we determined that not only should they not close their doors, but that within the next 12 to 18 months, they were going to be able to turn around and actually succeed as a business and be able to become profitable and continue growing. 12 years later, that business is still alive and kicking it. So what is cash flow forecasting? So simply, cash flow forecasting is a process of estimating the flow of cash in and out of your business. However, unlike a budget, a cash flow forecast is a continuous process that requires review, analysis, and adjustment throughout the life of your business. Folks, this ain't no 1 hour activity. A proper forecast takes a great deal of effort. It will require time and effort from both you and your team members. It requires analysis of historical and current data, economic and marketplace trends, and it requires skilled estimating and much, much more. So let's talk about a dynamic forecast versus static forecast. So static means fixed or unchanging. A static forecast, in essence, acts exactly like a budget, as it's never updated or changed. And based upon everything I just talked about with all the amount of effort you have to put in, a static forecast is a complete waste of time for you and as a business performance tool. Now, a dynamic forecast, on the other hand, means continuous change. And this is the type of forecast that you need to employ within your business. So let's briefly talk about the dynamic forecast process. It is a circular process that repeats over and over again, continuous. So you start with creating a baseline forecast. You then integrate actual results. You then analyze these actuals with your forecast and look what's going on in the marketplace. You adjust your estimates and create an updated forecast. And then guess what? Next month, you repeat this all over again. So does a cash flow forecast just include a P&L? Well, most owners and professionals stop at creating a cash flow forecast by just creating a P&L forecast. And while this is a good starting point, it is not a complete picture of your business and its performance. A proper forecast includes a P&L, balance sheet, and the statement of cash flows. And the reason is that creating a P&L forecast is a one-sided view of what's going on. And you can manipulate calculations and or not have a complete picture of analyzing the business, and you can make wrong decisions. So why do you need the complete picture? Well, I've been reviewing and fixing other professionals' cash flow forecasts for the majority of my career. And I'm telling you, unless you forecast all three statements, there's way too much room for error and inaccurate forecast calculations and results. And you're missing key data to aid with your business decisions. And I'm telling you, friends, that this is way too dangerous because you as an owner are relying on these bad assumptions to make extremely important business decisions. Where is the company headed? Will there be bumps along the way? Can you afford the debt you have now? Do you have the capacity to take on more debt? Can you afford to expand your business? When will you need to hire more employees? And much, much more. These are things that a simple P&L cash flow forecast cannot answer and should not be relied upon. So to recap, cash flow forecast is not a lighthearted task. It is one that requires the use of a trusted advisor. Thanks for listening to our advice in Cashflow Forecasting 101. If you appreciate our advice, please remember to like our video and subscribe to our channel for future content. Until then, remember, don't conform, stay unique.